stocks searching for direction heading into the close. The S&P 500 is fighting to extend its longest win streak in 2 years. We're also watching moves in the bond market as investors look for any signs of the Fed's policy path. In a series of speeches this week, Fed Chair Jerome Powell not commenting on policy in his speech today, but he's back at the podium tomorrow. Joining us now is Tim Chubb, Girard Chief Investment Officer. So, Tim, thank you so much for joining us today. So, Tim, the S&P 500, listen, we have, I think, 7 straight consecutive up days there, Tim. Today, not doing much. I'm just interested. Take us through the stock market. What do you see for the S&P 500 in the near to intermediate term here, Tim? Do we move higher?
Yeah, sure. Well, I mean, earnings season thus far, as you just were going through, has been, fairly unpredictable. We've had, estimates over the course of summer really get elevated, looking for 12% earnings growth in 2024 as well as in 2025. And, given the weakness that we've seen in some of the high frequency data points related to the economy, I think it's going to be really challenging. And, we have this reality where a lot of these companies, really benefited from this post-pandemic boom. They've had, pricing power as consumers just can't get enough of certain things, as well as companies reorienting themselves for a different workforce. And, we could be headed into a year where we sort of see this simultaneous loss of pricing power and volume, unwinding some of the impressive price gains that we saw, coming out of the pandemic, especially within goods. And, looking at, a pretty average quarter as far as beats are concerned, under the surface, about 70% of S&P industry groups have actually had negative earnings revisions. And so I think, as we kind of close out the year, I wouldn't be surprised if we're a bit more range bound, wider trading range. It's a bit more skewed to the downside as the magnitude of the earnings growth trajectory is priced out for next year.
Yeah, Tim, looking through your notes, it sounds like you're a lot more cautious on the economy. You say specifically that you think the recession fears are still very much there. What does that mean from a portfolio perspective, from an investing perspective? Do you sort of stay put where you are right now, or do you start to maybe shake things up a bit in anticipation of a further slowdown?
Yeah, well, I mean, I think it's really been a stock picker's environment as you're, illustrating some of the volatility that we've gotten throughout earnings season. A lot of the companies that have been, post-pandemic winners, now losers, especially with, rates at these elevated levels. And there's, multiples no longer looking nearly as attractive without having the growth follow through, at least here in the near term. And so we certainly don't think that the economy is going to be falling off a cliff. It's more wading into a swamp. And with that, it really means, looking at fixed income in particular, much more attractive in relative terms, to equities, which look expensive in absolute and relative terms. And so avoiding some of those more cyclical areas of the market, we really prefer more of a barbelled approach right now, having that late cycle environment type of positioning, focus on defensive growth, as well as some of those late cycle cyclicals that are also leveraged some of the more cyclical thematic, long-term opportunities that can outweigh some of the cyclicality within the economy. So within equities, we certainly like healthcare in the moment. I think as you look at some of the more defensive sectors like healthcare, staples, utilities, really the best bang for your buck, from a growth and valuation standpoint exists within healthcare. But these businesses have, very similar to housing last year, have gone through the recession. Inventories have been worked down. They've really been impacted significantly, especially with some of the CDMOs and CROs by, just the sort of absent, capital within venture capital and other companies that have, really been relying upon the capital markets for growth. And so we're starting to see some green shoots there. We're definitely starting to see some green shoots within China, since many of these tools and diagnostics companies are highly levered towards the Chinese healthcare growth story. But overall, late cycle positioning, taking some of the cyclicality off the table in sectors that tend to be more cyclical, like financials and industrials in particular.
Within fixed income, you mentioned that, Tim, that you see some opportunity. Where in fixed income exactly? Do you like treasuries? Is it corporates? What looks good to you?
Yeah, I think one of the most unusual parts about this economic cycle is we really haven't had the leverage of prior cycles that needs to be unwound. We had such a long period for companies to be able to refinance their debt in an ultra low interest rate environment. And so much of the risk has really been transferred off of bank balance sheets, off of even the high yield bond market and into private credit. And so if you look at historical default patterns within the high yield or below investment grade bonds, overwhelming majority typically come from issuers that are triple C and lower. about 50% of those issuers are now in the private credit space. And so on the short term, or excuse me, from a short duration standpoint, we really like the securitized side of things. Ultimately, we've seen this consumer weakness get priced in within consumer ABS. But on the corporate side of things, we're very comfortable taking on a bit more credit risk, realizing that defaults are not nearly going to be anywhere close to prior cycles. And it's a great carry trade on the short end of the curve. 3 years out at max. But to your point on treasuries, with the move up that we saw, in the better part of October, with the 10-year getting up to about 5%, we really saw, really being difficult for investors to see yields move a bit higher than that, especially given that inflation is no longer a concern, I think, of investors. It really is a growth, concern moving forward. And so we took that opportunity to bring our treasury exposure up within our portfolios, especially on the long end of the curve. We like that barbell approach of, the carry trade on the short end with the spread, and on the long end having much more stability and ballast, taking on quite a bit more interest rate risk. But in the event that we do get the recession next year and price cuts work through, having that long-term exposure from a convexity standpoint, I think is going to lead to outperformance in fixed income markets.
Yeah, balance and diversification, something we hear a lot lately. Tim Chubb, so good to talk to you today. I appreciate the time.